Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 301st podcast videocast for the week ending July 24th, 2025. A lot to cover today, but as always, family first. A couple photos here with John, Craig, Caitlin, my beautiful wife, Craig's wife, Sue, and Chris over at a restaurant, Crystal Cove. We had an incredible time talking life, talking business, talking all types of ideas. And huge shout out to Sue and Craig Bridgman, who are in from Dubai. Sue just launched her new book, which is called The CQ Edge. It's all about communication. She's going to be on Mornings with Maria on Fox Business, so you can find out all about Sue here. Then I want to congratulate my friend Andrew Keys, who just launched the Ether machine for all of you crypto nuts that love crypto. They're going public with over $1.5 billion of fully committed capital. Part of that, he's contributing a portion of his personal Ether holdings. He's contributing $650 million of his own Ethereum into it. They're going to do staking, restaking, so it has yield, and maybe something like the MicroStrategy of Ether. But I'm slandering it because I have zero competence or expertise in this area. I know a lot of you do. All of his details are at theethermachine.com. And he explains it for people who have an interest and an ability. I think the huge takeaway was when he was on CNBC and they said, why do you own Ethereum and not Bitcoin? And he said, why would I buy a landline when I could buy an iPhone? And if you understand how he speaks about it and look up some of his media, it's pretty interesting for those of you who have that competency. But I stay in my lane and do what I do best. We buy hammers and shovels and airplanes and amusement parks and easy peasy stuff that I don't have to predict the future. So, forgot the most important thing, which is Junior Olympics going on. We used to have to fly from the East Coast for this. Now it's right in our backyard. Both Mimi and Annabelle are playing their first games this morning. I'm going to be at probably 10 games over the weekend. But a couple quick highlights here. Here's Annabelle. And then, all right. So right here, gets down the field. Boom. Puts it away. All right. Very exciting. And then Mimi is doing incredible stuff. Look at this one. Boom. All right. Couple more quick ones here and we'll get right down to it. But this is what we do. Family first, ladies and gentlemen. Here she goes down the side again. Skip shot. And final. Watch this one-timer. This is pretty awesome. Boom! How you doing? All right, here we go. Thanks to my buddy who sends this over. Let's look at some charts here. We got a lot of great stuff. So yeah, we broke out here. Everyone's looking here. Recency bias. Oh, it's gone too far too fast. I've been saying it tends to keep pushing higher. Look, we are running out of some gas, but what you're seeing under the surface, here's the theme, ladies and gentlemen. Pay close attention, okay? Small and short. Small and short, okay? This is where money is starting to go because it's run out of things. Managers caught offside since April, sold in the hole, chase up, have to buy the laggards that haven't worked, which is now the most shorted stocks, which are concentrated in mid cap and small cap. And we're seeing all of our names just skyrocket this week. Just absolutely incredible. The things that have been left behind, that theme is going to continue. So even if this S&P comes back and checks back and scares the hell out of everyone who sold here and bought here. And now we go back down, or God forbid, all the way back down to 6,000 to really get these guys screwed before going up to the next level. So be it. Focus on what we've been telling you the whole time, and you are now smiling so wide you could eat a banana sideways. There's no question about it, which means we probably get some volatility in the next couple of weeks. So chillax. We went through, by the way, in episode 300, and again, thank you so much, all the loyal viewers making this thing go, and it's going to keep going, and it keeps growing. It's super exciting, delivering a lot of value. We went through, 30 something, I don't know, 15 or 30 names that we've discussed on the podcast, some owned by us and clients, et cetera, and basically saying, yeah, the market's moved a long way in a short period of time, but these names haven't even gotten started. And this week, a lot of them were just like galloping. I mean, like we've never seen before. So go back to the first part of that, and we're not going to go through all the names again. And just see what we're talking about there. So there's equal weight. It hasn't even broken out yet. This is where the laggards are. Look at small caps. These are the most powerful patterns for those of you who care about technicals. I don't, but I pay attention to it. The longer these things go sideways, when they break out, it is so monster. This is small cap index. This is where you're going to get your value. Yeah, it's had a huge run in the last few weeks. It's just beginning. When this thing breaks out, it's going to go for years. This is going to be like 2001 to 2006 for small caps. So pay attention. We have our exposure. You know where that is. And we're pretty excited. Here's Europe x UK. And so we got... all right. Then we've got Hang Seng. This is amazing. Talk about a choppy uptrend, but it's holding that and now looks like it's ready to break out to the next level before we start to work our way to new highs. That is exciting. We're starting to see it in BABA this week again, which is pretty cool. I could tell we were at a turning point at 105 when everyone was just puking, oh, it's not doing anything, blah, blah, blah. And we were just buying. It was so beautiful because we got so much new money in and we were able to buy BABA as a new position for the first time in a long time because it had shot up, blended basis $82. It had shot up to 148. And we weren't going to put new money in after, more than doubled. And now it pulled back, and now it's moving back up into the 120s before its next final move. This will be the most skeptical move of the entire time, and everyone will think it's going to top at 148 again, and it's going to just blow right through it, and people are going to go, oh no, and then all these people who sold at $60, who sold at $105, will be buying over $200. And look at this setup. I mean, it doesn't get any clearer than that. I mean, the measured move, you start to look at 1960 to 25. That's a 25% move. So BABA probably gets 30, 40, 50%. And then it goes. Look at my buddy Brendan's K-Web ETF. This sideways channel for 3 years. This thing is going to absolutely skyrocket. Tokyo could care less. 30-year, 10-year yields. So another fake out, move back lower. Here we go, ladies and gentlemen. Dollar counter trend bounce will resume downtrend over time. Euro, no one would have predicted this except for the incredible viewers of Hedge Fund Tips with Tom Hayes. Way to go. And all my skeptical Canadians, I said have faith. Here was the overthrow. Everyone got nervous. Now you've broken through the downtrend. You're retesting, and you're going to continue to push higher over time. Energy just in this range. Gold, couldn't get enough here. Hasn't done anything. We'll see what happens with that. I wouldn't be a buyer, but that's not what I do. I could care less. Copper, PhD in economics, is showing you what? China economy is recovering. Global economy is recovering, just breaking out right now. And then you look at some names. I thought there was one that was pretty interesting, which was Apple's been kind of dead money for a while here. Duke Energy. Here we go. Crown Castle. Long downtrend, broke out at 106. Now just reported earnings, had a strong earnings call. I think it's up to like 115. This is just early days. Now it's breaking out. Everyone's like, oh, what's your target price? None of your business. That's for my client's benefit, but a lot higher. Let's see. These start to look interesting as we consider consolidation in the railroad space, Canadian Pacific. I want to get some exposure in transports. I don't know if it's UPS or one of those, but Canadian Pacific is something I've got my eye on, and I want to start to study the railroad sector a little bit more carefully. Here's some more stuff from my buddy over at RBC. Yields, what else? Home Builder Index. Here's a beautiful base. It's sitting here at resistance, grinding sideways. This is going to be the rate play. You look at weekly momentum, everything, and you're starting to see the things move ahead. Generac is on a run. Stanley Black & Decker is on a run. Obviously, GXO with Brad Jacobs is on a run. Excuse me, not GXO. GXO is on a run. We own that. But QXO, the new building supply roll-up. So pay close attention to this for a tell. And what's in here? A lot of small caps and mid caps, which is consistent with what? Small and short. High short interest. It's very simple. Most managers caught sideways, still underweight, dramatically behind their benchmark, desperate to keep their jobs. They can't buy those things that have doubled off the lows. They got to buy those things that are lagging, and those are high short interest, smaller mid-cap stocks that haven't moved yet. And you're just seeing the short squeezes, and the shorts, it just goes so fast when they start to get squeezed. Obviously, so the example of Kohl's and things like that, but a lot in our portfolio. I mean, look at Advanced Auto Parts. I mean, I can't tell you messages I was getting at 30. Are they going out of business? Now it's at what, 70 or $80? I haven't looked at it today. And just getting started, by the way. Here we go. Oil Service Index. This is where National Oil Well Varco, a new name we talked about last week. Here we go. Early days, ladies and gentlemen. Moving along. I got to move along today. This got to get done. All right. So let's look at some of the indicators, because everyone says the market's overbought. We know the market's overbought. We know the market's frothy. We know we could get some consolidation. But when you look under the hood, the thing that's blowing my mind right now, besides all these indicators, the McClellan being in kind of mid-range versus extended range, is that even at Association of Active Investment Managers, they hate themselves because they sold in the hole, then they bought up, and now they're skeptical that they've bought up, which means it's probably going to keep pushing it in their face. But look at this in terms of breadth. Stocks on a PMO crossover buy signal. It's like a 50-200 cross type of nonsense thing, but it gives you an indication that's down at 0, which tells me breadth is weak, which means there can be a lot of, even if the indices stall, which they hopefully should, under the surface, there are a lot of names that can keep pushing higher, even if Mag 7 breathes. Same with Dow Jones. So we got the PMO by all, then PMO by Dow Jones. This is not what you see at super tops. This is what you see, where breadth expands, and it's a sign of health in the market. Same with PMO by SPX. Again, we're not like up here or up here. It's just it's what I've been saying for 2 weeks. If you look at all the media, like 4 hours of media that I did last week, and I explained how during V-shaped recoveries, and that's what made us so successful during COVID, it's when you come 25, 30% off the lows in a short period of time, that overbought pushes, because it just, so much money was wrong-footed that irrespective of the multiples or the fundamentals, they are panic buying. It's like throwing someone a bottle of water in the desert. They got to buy anything that hasn't moved. So Hail Mary, hope they've got nothing to lose. Hail Mary, hope and a prayer they can catch up and keep their jobs. So um, everything X the heaviest weights now has to be bid by these people who got it wrong. Okay, and it's the majority of managers got it wrong, not the people on Hedge Fund Tips with Tom Hayes. You guys got it right. I keep getting these messages. This guy's like, oh, I made this and this and this and this and this and this. And I was like, and I'm looking at all his names. I was like, he didn't even get in them at the lows. Like he just got in them a few weeks ago. It's like, oh my God. And he's happy. So there you go. This we're keeping an eye on. Okay. If this moves back up to, 170, 175, we may be at or near. This is when the smart money starts to buy insurance, one standard deviation plus out of the money, expecting like big corrections, 10% plus. We're not there, and this tends to climb a wall of worry. So again, I just try to be dispassionate, unbiased, look at the data and play the probabilities. And right now it tells me that the type of names we're in probably have a little bit more gas. And then you got this kind of ambiguity. This is not an extreme bullishness or bearishness. This is confusion. Confusion tends to be wall of worry climbing environment. Cox Automotive Report from Tuesday, key highlights, retail sales. Oh, by the way, I forgot to thank Mark for having me over to NBCC, and the reception had such an incredible day over there. No pictures for that one. Jesse, for having me over to your office and sharing ideas. I really enjoyed that time. Thank you for that. All right. Retail sales for new and used vehicles are rising in July, signaling renewed consumer momentum. Loan rates are easing from 25-year highs, with low interest financing reaching levels last seen in mid-2022. Dealer activity is up year over year on Auto Trader and DealerTrack, pointing to strong consumer engagement. Consumer spending rebounds. June is now accelerated back to April levels. Weekly spending trends show renewed upward trajectory. Consumer sentiment index rose 0.7% in July after a 3.6% dip in June. Retail sales strengthened. New sales are trending higher compared. Why is all this important? Because we have a huge position in Cooper Standard from May of 2022 when we initiated at about $5.10. It's I think it got close to $25 this week. This thing is going a lot higher, and the volumes haven't even begun yet. Now they're beginning and they're happening, and we're pretty excited. Warren Buffett, price is what you pay, value is what you get, which is effectively the theme of Hedge Fund Tips with Tom Hayes, not getting distracted by shiny objects. Munger, our job is to find a few intelligent things to do, not keep up with every damn thing in the world. I mean, I talk to these geniuses in crypto space and technology encryption and all this stuff, and I'm like, listen, that's above my pay grade. I just buy hammers and airplanes and rubber sealing stuff and generators and things like, roofing supplies and things I could totally understand with predictable cash flows. I don't have to be a genius. We could just make doubles and triples every few years, rinse, repeat, and sleep like a baby at night. So we'll do that. We'll leave the hard lifting to the super smart people. Let them make their 100 baggers in their businesses. And then when they cash out, they can give me 20, 30% of it. I'll run it for them. They can sleep like a baby, and everyone's happy. Another awesome picture from a guy from Dylan C, who's wearing his Hedge Fund Tips polo out to the Hamptons this summer, right before he starts his investment banking job straight out of college. Thanks so much for sending that in, Dylan. You are on your way, my man. And for those of you who want to get up on the website, tons of orders for the merch at hedgefundtips.com. Click on the hat there. You can get yours and support it and show people you are in the know. But more importantly, be part of the community. Get your pictures in. Let's put them up and show how awesome you are. Moving along here to pod chart information. Let's go to Lithium. On the mend, we're going to cover that in the weekly article. That's a big deal. As you've seen with Albemarle, couldn't give it away a few weeks ago in the 50s, now in the 80s. So it's a real fun time. I got to be honest with you. Global equities, breadth is improving. This was consistent with our theme. Here is the healthcare select sector versus the S&P 500. And I look at Baxter and I just continue, this is very similar to Comstock Resources. We've had a huge run in it, but that was our only energy exposure, and rightly so. And we're just like, God, we're going to need more exposure in energy. And we laid out National Oil Well Varco. God, this again is a once in a lifetime opportunity here. Healthcare relative to the S&P going all the way back to 2000. I really want more exposure than just one name. So we're working on a bunch. But in fairness, actually, I don't lose sleep at night because we have the biotech basket, which is going to take off as this takes off. And we have that. But there's a lot of opportunity in healthcare. If you've missed everything and you're just joining us recently and haven't benefited from all the stuff we've been talking about in this huge run, since the beginning of the year, by the way. I mean, we've not just the last few months. Healthcare would be where I'd start to pay attention. Healthcare and small caps. China's made a huge contribution to global money supply, which is a huge driver. Flows into emerging market equity funds in the past 2 years going parabolic. How you doing? No one expected except for you, the incredible supporters of Hedge Fund Tips with Tom Hayes. Moving along. By the way, I just want to thank you guys because I know not everyone can afford to become clients, but I have been getting a lot of clients in that I say, where'd you hear about us? Blah, blah, blah. And more people are like, well, my friend told me about your podcast. I've listened for the last 6 months. I've made some money off your ideas, but I got a business to run, a life to live. I'm already rich. I don't want to watch markets. So it's working. And that's the type of thing that we see, and we just want to keep going because we know you guys are out there doing whatever you can to give back, and we're grateful for that. And we're going to continue to deliver this value to reward that. And I'm humbled by seeing you guys going out there helping people you love and sharing it and not being selfish and keeping it for yourself. So thank you so much for that. Now, if you look at emerging markets going parabolic, this is, by the way, the most rewarding ones are the ones that had no money or had very little money and have made enough money listening to the podcast that are now becoming clients. Those are the ones that are blowing my mind more than anything else. And I can't tell you what those calls mean to me. So, okay, emerging markets allocation, global mutual funds. So they are still unbelievably underweight. Remember 2001 to 2006, they went bananas. We're here. We're just coming out of the woods and people don't believe it. And that's the beautiful time to be involved. Diverging small versus large cap stock dynamic in US versus rest of the world, small versus large price. Here's the opportunity, guys, going back to that analog early 2000s, record inflows into materials. That was, we were pounding the table. Last shall be first. We did it in December, guys. Now people can't get enough Albemarle, and it's early days. 4-week average in share buybacks versus the S&P 500. You can see that strong and long. S&P 500 earnings revisions, breadth going up in a massive way. Again, not the things you see in unhealthy markets. This is the things you see off the lows. And if you remember this huge move, March, you had a retest in 2023. This is 2022 to 2023, 2022 lows. This is when we were buying tech when no one wanted it. Amazon and Google, quick doubles there. This lasts for a while, ladies and gentlemen. This lasts for a while. That's why I say, we can consolidate. Yeah, we're overbought. Same thing here. They didn't believe it. U.S. retail sales by kind of business. Motor vehicle is at the top of the chart. Store retailers, top of the chart. Clothing and clothing accessories, top of the chart. Bracken, you better deliver for us this quarter, my man, because our fingers are bleeding getting buying in stock at $12 here. So let's go. EPS and revenue beat. Huge earnings quarter, just as we expected. Remember, I said bar so low you could step over it, don't have to jump over it. Secret happiness, low expectations. This is what it looks like. Historical sector weights. IT is going back to 2020 high, 2000 highs, and healthcare back to 2000 lows. This is what you wanted to be buying here. We got to get more healthcare exposure. That's all I'm saying. I mean, we got enough with the XBI exposure and the Baxter, but this is when I want to be greedy, when others are fearful. This is when I want to be greedy as hell. If I was a hedge fund guy, I'd probably set up an SPV, special purpose vehicle for all those sophisticated people, and just load it with 5 healthcare names and, add some leverage because the time is now. So there's a hint for those of you listening in. Here's biotech just starting, guys. This is going to break through and just crush it. And we do have a lot of exposure there, so I'm excited. That's, again, sideways channel. When these things break, they go for years, not minutes, not weeks, not hours. CTAs are about to double their equity exposure over the next 2 weeks. Again, revisiting biotech's lost decade, going back to the early 2000s, right before boom time. Healthcare, guys, biotech, realized and consensus EPS growth for U.S. equity indices. What's going to grow the most is small caps. Negative last year, 21% this year, 37%. Still can't give them away. What is going to lag S&P this year? Only 7% earnings growth. Look, double plus, almost 2.5x earnings growth, 25 to 30% lower multiple. You got to have small cap exposure. Valuations have the high. By the way, all this is opinion, not advice, for education and informational purposes only. Go to hedgefundtips.com, click on terms. While you're there, get a hat. Why not? All right, moving along. Valuations have the highest explanatory power over long-term 10-year returns. All this means R2 of R squared of relative forward PE versus subsequent return spread over various time horizons since 1985. Russell 2000 versus 1000. All you need to know is short-term market's a voting machine based on emotion. Small caps are in the hole, despite this performance. Long-term, it is a weighing machine based on fundamentals. Price catches up to fundamentals. Whether it was Exxon at $33 during COVID, or Wells Fargo at $25, or Rolls-Royce at $1.50, and on and on, or on and on. Vornado. If your framework is correct, all you're doing is playing the time arbitrage game. That is our edge. The time, the patience, and the low leverage, so we can wait until the fundamentals, the price catches up with the fundamentals. We benefit from the short-term emotional voting machine, and we cash in on the long-term fundamental weighing machine. All right. Performance of the S&P and tariff-exposed stocks after the major tariff announcements. Liberation Day. Okay, that's just... Most borrowers have mortgage rates well below current rates, leaving them with a large financial disincentive to move. We expect existing home sales to rebound modestly over the next couple of years. Trump is toying with an idea of eliminating capital gains on house sales. If that doesn't motivate people to do it before he gets out of office, nothing will. I think it's a brilliant idea, and no one else would think of that. That could be huge. More shelter disinflation likely in the pipeline. That's good news for inflation. Russell 2000 net speculators, net position, record lows here. That's when you want to be a buyer. XLE looking like it wants to potentially break out and move. We think that's going to be the case. But we want to be careful not to be too exposed to the commodity price. If drill baby drill comes to pass with lower interest rates, then we want the toll takers, in which case, and we don't like midstream. That's kind of just a dead money for yield play. We like the servicers like National Oil Well Varco. Services companies. Foreign purchases of both U.S. stocks and bonds surged in May. Analysts see no profit downturn. Okay, yellow light. Retail activity as percent of overall market shares traded, edging up. That's normal. We also had that, by the way, that's natural. You had that after the lows in June of 2020. And this reminds me of so much of that period because the market moves so big off the March lows, which, by the way, we called on March 19th in marketwatch.com. Go to the website. You can find it. Anyway, I remember everyone saying, we're overbought, we're going to go back and retest, blah, blah, blah. This is not resolved. We don't have a vaccine, blah, blah, blah. And we just held pat and that was just such an incredible year. So now we're there and people are saying the same thing. It didn't get, we should watch this because this was more the peak. Even after you peaked, you had another 12 months until the beginning of 2022. So we're early days, not late days, is what that one data point would imply. NASDAQ composite, present index to 100. So again, this implies, huge move, but these huge moves tend to continue to resolve higher. So keep that in mind. People are still underweight. Look at the percentage who say they're overweight equities. It's not what you get at highs. Highs are up here, up here, up here, up here. I mean, God, the reason I'm so animated about this is I can't imagine how screwed all these managers are and how dramatic they're going to have to buy on margin to potentially keep their jobs. And at this point, they've got nothing to lose. Some of these guys are 30 points behind the benchmark. So they got to lever up and throw the Hail Mary and pray that the ball lands by December 31st, or they're going to be, your next top chef is really what it comes down to, or taking you around in an Uber. FMS investors taking higher than normal risk levels. We're not there yet. We're starting to get there. We're not there yet. Vehicle affordability is coming down. This is constructive for volumes. Here's this Alibaba Group chart. It's now back up to this level and breaking through. This is a long cup and handle, yada, yada, yada. Measure move, 60 to 120 implies 180 next move. And then I've seen all these other silly charts at 220, and it'll get there. It'll get there. So 1 year change in metro level home prices between June and July. This tends to be the leading indicator. It's called Florida. And we're going to start to see some softening here that we've been talking about in prices, more affordability. That's going to be a positive thing as supply comes on, as rates come down. Only Mag 7 earnings have rebounded. The rest are starting to rebound. We know that trajectory into 2026, 2027. Data centers as a percentage of U.S. power demand continue to go up. The only thing is I had a really smart guy start to talk to me about photonic chips. And they're going to require a ton less data center and a ton less energy. It's years out, but that's something. And by the way, let's just say we're excited about that. Move along. S&P 500 cycle composite for 2025. Okay, so this implies from Ned Davis research that we're kind of at the peakish, and then we consolidate sideways. And this, the beauty of this is, if this is correct, which it may or may not be, my inclination is we probably do have a little more. We definitely have a lot more under the surface. Maybe the indices look like this because this is basically a Mag 7 chart. If you're spending a lot of money buying puts or getting short here, you lose 100% of your premium. Because you're not going to get the pullback. Your recency bias is where you're screwed. You're thinking, oh, we just had a 20% or 25% correction, whatever it was, we're going to get another big correction. Ain't going to happen. Okay. We've had 3 of them in 2022, 2024. I'm sorry, 2020, 2022, now 2025. You usually get 3, you get one of those every 4.1 years. We've now pulled 3 into 4 years. You're not going to get that. You might get 5 or 10%, but that's not going to be enough to make the options pay out. So suck it up, Buttercup, get off leverage or any material leverage, and just ride out the volatility, and it'll revolve higher by the end of the year. Go on a cruise for the next 3 months, okay? Utilities versus NASDAQ by decade. That's not useful right now. Here's showing corporate insider sell to buy ratio. It has no indicative power. Selling, they sell for a multitude of reasons. They buy for only one, unless you see excessive stuff like we've talked about some names. But this example shows the rally continued for another year and change, another 6 months and change, another few months and change. So we're not even at the level yet, and then you probably have another few months, which again, I think this is this could surprise people up to October, which would be atypical to have any level of continued stability through August and September. Usually you'd get instability in August and September. So we'll see. Maybe it'll be the function of the shadow Fed or the Fed actually doing the right thing. But all right. Again, here is tech and X-Tech. Again, extreme. That's where you want to be, is where the puck is going, not where it is in the rear view mirror. 5 biggest stocks. Boy, we got a ton this. Magnificent. Okay. Other 493. So again, this is your trajectory. Mag 7 decelerates, drops off the cliff, then stabilizes on Magnificent 493, catches up. Median wage growth is declining. It's good for inflation. Corporate profits. Oil and gas stocks most likely to have bullish ratings. Southbound outflows, huge flows into Hong Kong. Healthcare again, this is a consensus forward 12-month PE valuation versus history. There's a lot of ponies in that pile, guys and gals. Sellers, earnings sentiment. Money market fund assets as a percentage of S&P 500 market cap. Okay. Coalescing letter. What is this? Ghost postings. Labor market continues to weaken. That we know. Fed's got to move. It's going to be too late, Powell. Get on it. Just announce the shadow Fed. This guy's not going to do it. He's got to stick up his butt. I mean, consumer attitudes about jobs. Market's still weak. Like to see that. Percent of S&P 500 stocks in a bear market trending down, but not at an extreme that you would see, before bad things happen. S&P earnings, beat rate 85%, surprise 7.6%. Medicaid exposed insurers have been crushed. I think there's a pony in that pile. Prime book is getting a little stretched, so there's that. Record bearishness. Percent of publicly traded companies experiencing net buying from corporate officers and directors. So keeping an eye on that. So, you got to take all of these and probabilistically bet. And it's, it's complicated, which, it's like when you can't read the break on a putt, you just go back of the cup, straight down the middle. And that's kind of, I think, where we are. I don't think it's going to break up huge, and I don't think it's going to break down huge for the next few months. I think it's going to be sideways chops. So just put it in the back of the cup and benefit from being in the laggards that these managers are forced to buy. Small cap underperformance relative to large cap has been its greatest in history. Small caps represent the greatest U.S. market opportunity, which is from Seth Golden. We agree. That's interesting. Cap weighted. So, like, worst case scenario I see would be a retest of this before pushing higher. Equal weighted. Again, that this shows under the surface just breaking out. Again, a lot of great data this week. Good work on that, Jeff. China defends growth model, plans consumption as greater driver. Alibaba, the toll taker. Markets bet Beijing is getting serious about China's overcapacity. That's why you're starting to see some movement on Albemarle. Chinese stocks in Hong Kong rise to highest level in 4 years. Headline you did not expect to see 2 years ago when we were pounding the table. China investors snap up Hong Kong stocks as flows near record. Alibaba upgrades flagship Qwen 3 model to outperform OpenAI. DeepSeek in maths and coding. Bessent sees China tariff truce extended in Sweden next week. Bullish. Trump mulls removing capital gains tax on home sales. The aim is to juice the housing market. Juice, baby, juice. Home builders are slashing prices at the highest rate in 3 years. Cleveland Cliffs CEO says surge in domestic auto manufacturing is imminent. How you doing? Cooper Standard. Smiling so wide we could eat a banana sideways. Fed's Waller hints at July dissent as he makes the case for rate cut and the job as Fed chair, which he'd be a great one. Trump signs stablecoin bill delivering win for crypto industry, which means stablecoins, which means PayPal, which means demand for treasuries, which means lower yields, which means off to the races. Juicy dividends tempt investors into lagging high yield stocks. How you doing? We've been talking about it for 6 months. Looking for cheap stocks. Healthcare shares haven't looked this good in 30 years. We agree. PayPal taps wallets from China and India to make cross-border payments easier for 2 billion people. Alex, Chris, turning it around, baby. Stock going up like nobody's business. Japan has committed to purchasing 100 Boeing aircraft as part of the new trade framework. Unbelievable. Opinion follows trend. Eurozone private sector grows at fastest pace in almost a year. International versus ex-US. Now, the crown gets its shine back. Stock market and sentiment results. Each week we cover 1 to 2 companies we previously discussed in podcasts for our own clients, including personally. So what do you see here? You see a divergence. Record cash flows. Prices come down a lot. Short-term voting machine, long-term weighing machine will catch up to those great fundamentals, which are going to get better because they no longer have the drag of the fiber business. With a portfolio of 40,000 cell towers across the U.S. Crown Castle is the nation's largest provider of shared communications infrastructure. Number one thing to know with CCI is that, like all REITs, it trades on interest rates. When the 10-year yield falls, REITs tend to benefit, and CCI is no exception. You can see the overlay here. Whether it's the removal of supplementary leverage ratio or the Genius Act and stablecoin catalyst potentially creating $2 trillion of treasury demand and setting up an Operation Twist type scenario, we've been making the case lower 10 yield for quite some time. This view is central to our thesis that dividend yield remains cheap and overlooked, allowing us to add high-quality dividend-paying names that are at fire sale prices. Think CCI, 3.85% yield, Stanley Black & Decker, 4.51%, Baxter, 2.5%, Hormel, 4%, and Diageo, 4%, to name a few. The point is, these dividend players have been ignored and left for dead over the past few years, but that won't be the case for much longer. Once the Fed wakes up and starts cutting, they'll be in high demand in short order. Dividend yield inexpensive, most inexpensive since 2001. Dividend yield neglected by managers. They will be chasing like you're seeing them chase off the April lows. What you will immediately see is that a good chunk of the 7.4 trillion sitting on the sidelines in money markets earning over 4% yields will suddenly be forced into find yield elsewhere. At that point, investors will be tripping over themselves to get dividend exposure and will be more than happy to help them out. Sold to you. That's tomorrow's newspaper today. Until then, we're happy to sit on our hands and wait as CCI and the rest of the high-quality businesses continue to execute accordingly. That brings us to CCI's Q2 results. This was another lights-out quarter for CCI, beating both top and bottom line expectations and raising full-year guidance. The sale of the capital-intensive fiber business remains on track. to close in the first half of 2026, leaving CCI as a higher margin, leaner business and the only publicly traded pure play U.S. tower company out there. The next big catalyst will be the announcement of new CEO. Second time's a charm. And in the meantime, buy a business that's so great a ham sandwich could run it, because one day they will. CCI is a perfect example. And in the meantime, just get a beating heart. This business is so good, it'll work with or without a good CEO. The business continues to hum along with organic growth rates accelerating to 4.7%. The Sprint churn overhang largely gone by the end of 2025, and secular trends in the mobile data consumption and 5G driving annual wireless data demand growth of 20 to 30%. Here's everything you need to know following Q2 earnings. You see it all highlighted. Let's go to the top 10 points. Number one, management raised full year 2025 guidance, increasing site rental revenues by 10 million, adjusted EBITDA by 25 million, and AFFO by 35 million in the updated outlook. Two, higher leasing activity drove organic revenue to 4.7%, adjusted for the 51 million impact on Sprint cancellations. Management continues to expect even stronger leasing activity in the second half of the year. Three, I feel sorry for those of you who are listening to me on 1.5 times speed. Good luck. The 8.5 billion sale of the capital-intensive small cells and fiber solutions business remains on track to close in the first half of 2026, with CCI already securing state-level approvals. Once completed, Crown Castle will become the only publicly traded pure-play tower company focused exclusively on the U.S. 4. Capital allocation priorities following the fiber sale still remain unchanged. Reducing $6 billion of debt is the top priority. Any remaining cash flow will be directed toward the share repurchases. After the sale, management expects to grow the dividend in line with AFFO while maintaining a payout ratio between 75 to 80%. Management remains confident in the rollout of 5G networks, noting that the previous 4G deployment cycle lasted 10 to 12 years, and that the 5G cycle is still expected to be even longer. Continued strength of incremental mobile data demand. Carriers continue to report strong results, with overall traffic increasing, subscribers growing, churn rising, all of which typically lead to higher investment activity in wireless networks to keep up with incremental demand. 7, service gross margins continue to improve, with management raising the full year expectations to 75 to 105 million, an increase of 5 million from the previous outlook. They expect gains to be made over the last 6 to 12 months to be structural and sustainable going forward. The board is actively searching for a new CEO, with a decision expected before the fiber business deal closes. Management remains committed to maintaining an investment-grade balance sheet with approximately 86% of debt at fixed rate, weighted average debt maturity over 6 years, and 4.7 billion of availability under a revolving credit facility. Sprint-related churn is expected to be largely behind CCI at the end of 2025, with management reiterating long-term churn expectations of just 1 to 2%. So read through the earnings call here. Albemarle update, okay? By the way, huge move from 49 to about 80 this week in just a few weeks. Our timing on the media stuff couldn't have been more perfect. Albemarle is the world's lowest, but here's the key, just getting started. Albemarle is the world's largest and lowest cost lithium producer. The stock has been on a tear over the past month or so, up close to 40% as lithium prices continue to rebound off multi-year lows. A big part of the story is what's happening in China. Over the past couple of weeks, the Chinese government launched a campaign focused on anti-involution, a push against self-destructive price wars and excess competition. This move is part of a broader effect to address chronic overcapacity across many sectors and the resulting deflationary pressures. To the benefit of Albemarle shareholders and the overall lithium market, China has already begun implementing the plan. Just last week, Chinese regulators ordered the closure of Zhangyi, a major domestic lithium miner with 11,000 tons of lithium capacity. This is welcome news for Albemarle, as one of the major drivers of the ongoing supply glut was the flood of small-scale producers in China, many fully subsidized, chasing record-high lithium prices we saw in 2022. As expected, the longer prices remain in the pain zone, the more lower quality marginal producers will get taken out on a stretcher. Albemarle management estimated in their last earnings call that about 40% of current lithium capacity is at or below break even, with only around 1/3 of that supply having come offline so far. If China is serious about curbing over capacity, it's going to be a busy season for stretchers. Okay. And not only are the subsidized player in China getting taken out on stretchers, but so are the geniuses who shorted Albemarle in the hole back in May. Of the approximately 117.7 million shares outstanding, nearly 20% were short. Morons. A short interest has fallen to 16%, setting up even more pain ahead. Keep in mind, despite the past couple of weeks feeling like a big move in Albemarle, the most exciting part is the train hasn't even left the station. This nearly 40% rally has come off just a 15% rebound in lithium prices off the recent lows to 9,800 per metric ton. Just wait until the operating leverage really kicks in when prices climb back up to 15,000 to 20,000 per metric ton range. At that point, we'll be smiling so wide we could eat a banana sideways or two, and Albemarle will be minting more cash than they know what to do with. Zoom out, and the big move in lithium can hardly be seen. This thing is just getting started. Lithium supply and demand imbalance, it's coming into balance. Fear and greed, yeah, a little froth there. National Association of Active Investment Managers confused, just as they were selling at the lows. They don't know what to do now that we've moved up. All opinion, not advice. Earnings, ARC, Cathie Wood ETF, top 30 weights, earnings estimates down 2.5% for this year, 1.15 for next year. And then oil and gas slaughtered, down by 16% for this year in the last 60 days and 16.7. That's why we want to get involved. I think we're completely flushed expectations. There is one, if you look here, what are the couple of names that have actually had earnings estimates go up while the sector is down 16%. And one of those names is right at the top of the list. It's called National Oil Well Varco, NOV Inc., which we covered in detail last week. So economic data, I think all that really matters is what the Fed does next week. All the rest of this is noise. Building permits low. Obviously, they can't take that risk with rates where they are. Fed is just gumming up the system, and we're biding time until they wake the hell up, or Trump announces his pick and the shadow Fed kicks in. 83% of companies have beat so far. Growth rate is 4.6. That's above 5.6, above 4.8, and I think it's going to move even higher. Ask me anything questions. Let's rock and roll. First one. GPN, we've covered, not for me. I know Elliot's involved. We like PayPal. All right, we're going to get through these quick today. I don't have another hour to do this. Philip, how do you establish your fair value on CCI in their transformative journey? A lot higher, moving along. Clients will know when we've hit fair value when they get a notification in their Interactive Brokers account, sale made. We're not anywhere near yet. Jason Greenblatt, I hope you're doing well. Keep up the great work. All of your names are flying. Big moves haven't even started. Hoping to get your thought on Baytex Energy. Okay, BTE. Cash flow is recovering. Revenues haven't started to recover. Margins are recovering. Let's take a look at the these guys do. Acquisition of crude and natural gas. Oh, so this is E&P. So you're going to be at the effective prices with this. But let me take a look. Yeah, I'd want to see their credit line. They got a huge amount of receivables for some reason that aren't getting paid. $1.5 billion of debt. So I would go through their filings and understand their liquidity. I mean, 400 million of free cash flow last year is pretty significant. Don't love that they've added 300 million shares. I really, maybe they did an acquisition. Find out if this is just, this is probably acquisitions, but you're issuing stock down here. I hate management that does that. You buy stock down here, you don't issue it down there. I don't like what they did to the share count. I mean, it's, you know, it's up from 350 million to 800 million in 6 years. I really hate managers like this. I'm going to be straightforward. I got to say, though, I think there's a margin of safety, and I think the timing is right. So I want to know, you got to do solvency analysis. What availability do they have in terms of credit? What's the sustainability? Why were all those shares issued? Was it for dumb acquisition, giving away stock at a low price, or are they just giving themselves a ton of stock, or are they using it to raise capital? Find out why they're such disrespectful pigs when it comes to equity. And if you can get comfortable with that, then maybe it's a buy. But higher and better uses. But I think you're on the right track with this one, despite the hair. So, okay, yeah, that's Dylan did that awesome pick. JT, hope you're not stuck in an airport. Take a quick look at BTU. Yeah, you're probably fine with Peabody. I mean, I don't know. Cash flow's going down, though. Like, might already be priced in. I think there are higher and better uses. What is this? Is coal business. I don't think you need to go that far down, and it's. I think you got an upside of, you know, maybe a double. But it's not my favorite. I'm going to pass on that one. It's not bad. I think you'll make money if you buy it here and hold it for 6 months, but it's not. All right. Okay, that's Andrew coming in. Diego, Pallets, BTE. We just did that one, so thank you for that, Diego. I guess that must be making the rounds on social media because getting the same questions. Thoughts on Humana? This is one that is on our target for healthcare exposure. We are not making decisions. We got to just unpacking this impact to Medicaid cuts is like a pain in the ass, but my guess is it's overshot. But I got to be certain before I get super comfy. Lemonade, this is the automated insurance company. Maybe they're finally there. Let's take a look. Still not cash flow positive. Revenues keep going up. Margins recovering. What are they doing on? By the way, is this a carrier or just an agent? Because I think agents are done in the next 10 years. Provides various insurance, except for the really high-end bespoke stuff. Renters and homeowners. Agent for other insurance companies. I think it's going to be me too. I mean, they're the innovator in this space, so it's not cash flow positive. So for me, it's like not that interesting. These are like guesses on the future type of companies. And in that case, I understand what you're doing, and I think you're right, but it's outside of. I got to make a leap into the future of who's going to be the winner of a new technology, and I'm not really willing to do that. Okay, so these are all people asking to invest. Unfortunately, we closed out for smaller accounts. So if you're 5 million plus, call me today. We'll get you in. If you're 1 to 5 million, you got to wait till October 1st. Gasper Moharic. What is the price of Euro USD a year from now? No effing idea, but Euro will be higher. Thank you for the question. Jeffrey, that's another inquiry. Daniel Borkman. Yeah, okay, thank you. We covered that with the capital gains. Alex, Claris Corp. I know the chairman too well. I'm not going to comment on this one. Lee Foster. Potential breakup of Kraft Heinz, bullish. Alex B. Covered that. Claris. Mike. Dan. Conagra Brands. That's Dan D. Yeah, they're just revenues are just showing no sign of recovery, or their margins. But how much of that is priced in for a company that owns some of the greatest brands known to man? I mean, the thing about this is, like, even if you do a great job, maybe you make 75, 80%, and you're going to have to wait a while because this is still breaking down. Bird's Eye, Mary Callender's, Duncan Hines, Healthy Choice, Slim Jim, Ready Whip, Angie's. Yeah, I don't love these brands. It's just, let me just get you a financial answer, because I don't really like this one. I've looked at it. I think you're going to be right. I think it's going to be okay, but I think there are higher and better uses, and I do like your thinking on it. I mean, 1.6 billion of free cash flow, not too shabby. It's a lot of debt on those kind of brands. I just don't think the upside warrants the risk, even though the price may move in the short term. Gleb, Tidewater we covered last week. We prefer National Oil Well Varco. This is another social media stock, TDW, I think. I mean, anyone that could destroy that much value that quickly, I'm not a fan. You're probably right. I just would rather a sure sleep at night bet like Varco, where I can make a triple or quadruple, versus something like that where you're hoping for a 10 bag if management doesn't completely screw you like they have in the past. It's like, oh, I don't expect the Scorpion's going to bite my back again. Well, shame on you. That's what Scorpions do. Charlie's asking about reweighting and all that stuff. That's for clients. I would just say that you sell a company when it's reached your fair value. You don't, I mean, if it becomes insanely overweight in the portfolio and it's frothy and near fair value that you decided before you got in where you were going to get out, then you can trim, but generally let it run to fair value and then just get out. So your podcast, been listening to your podcast since 2020. You helped me navigate my first internship on Bay Street in Toronto during my senior year. I most definitely continue to use your advice along. It's opinion, not advice. Along with the knowledge and pass along to your listeners, eventually have enough capital to give you to manage money for my family. Once again, I want to thank you for all your hard work. We really appreciate your thoughts on Whitecap Resources. Okay. These Canadians love their resource plays. Cap. It's like in your DNA. You guys cannot live without commodity stocks. It's just like, it's like oxygen for you people. Which now's a good time. So I'm not knocking you. WCP. I mean, it's just breaking out. Like where the time to be asking me this question was in 2020 when it was $1, not at 2025 when it's at 10. Free cash flow is actually declining and it's at new time highs. So I'm going to say pass on this one, Joe. There are better opportunities. Yes, it's breaking out. It might continue, blah, blah, blah. But I think there are better opportunities right now. Let's see. Lewis here from Nottingham. Lewis here from Nottingham in the UK. Been following you on the podcast now for about 6 months. If I'm honest, I wasn't your biggest fan at first. As a new investor, I was heavily invested in shiny things, a lot of Mag 7, and I'd hear your views each day on socials, which were generally negative for all my investments. That said, I dipped my toe in the water on CPS and obviously got a double bagger, which was great. I'm now invested in most of your picks. And I've seen great short-term returns, QXO, Generac, Albemarle, Estee Lauder. Hopefully this is just the start of the ride as I'm in for the long term. Number one, do your own work. Glad you have had that positive experience, but do not be buying it because I buy it or talk about it. You buy it because you've done your own work and you've come to the similar conclusions, or don't buy it because you came to different conclusions. Self-responsibility. But you're interested, however, in your views on Grab Holdings. I'm putting all my UK mates onto you, so you're getting good traction from across the pond. Fingers crossed, maybe in a position to become a client next year. Very awesome. Thank you for all of that. Let's take a look at Grab. And that's the way it goes. Pay it forward, share it with people you love, and we'll keep delivering the value. Okay, turning positive free cash flow, margins going up. What's the balance sheet look like? I generally, by the way, I do not like the food delivery business. But this one also has financial services, etc. Wait a second. This has a $21 billion market cap on 23. All right. So it's one of these 10 times sales stories. And the problem is the revenue. Obviously, they got the COVID boost, and now the revenue is like starting to recover. But to justify 10 times sales, you really need a super growth rate, and it's just not occurring here. I think on a trading, if I had to look at it on a trading basis, maybe you get a double. I just don't think that the business is justifying where it is now, never mind a lot more, even though it's probably going to go there on a trading basis. So let's see if we got any other stuff that we haven't covered. No, that's going all the way back. That was July 12th. Adam. Elevance Healthcare. I don't understand this one enough, but we're looking at it. This still looks like a falling knife to me. This is probably hit by Medicaid cuts. I'd hold off on this one for now. I think you're gonna have time to buy it. We'll revisit that one in coming weeks. Marco, Deckers. We covered this. I'd rather risk reward. I like betting on Bracken. I don't think it's come down enough to be interesting to me. That's had a run already. That's yesterday's news rear view mirror. Brad Tomlinson, ONL. It's a REIT. You got to know the properties. This one, we've covered this one before. I don't know the properties. You really have to underwrite each of the properties in their portfolio, and then the balance sheet, right? It's trading down because they're going bankrupt, and you have to come up with a case. No, they're not going bankrupt because the asset value, the vacancy rate, all those other things. I could only do that with Vornado because I know the buildings, so not for me. Even though it'll probably, I think like buying office now in aggregate, home run. I'm probably late. We were pounding the table telling all of our real estate clients, if you're in real estate, like buy offices like crazy a year and a half ago, and now that they've just moved huge. So, but that's not what we do. So we stay in our lane. All right. So Matt wants to know if we're looking for shorts. No, we're just going to buy at our time. This is going to be a sideways chop, if anything, and not a big correction of 20%. So I think it's just a bad use of mental energy and capital. I think you just sit tight on low leverage, ride it out, and finish the year with a smile so wide you could eat 2 bananas sideways. Regarding management, this is from Unknown. Regarding management claims and forecasts, how do you gauge when to trust this fully? To what degree turnaround situations with new management? I look at their track record. I only bet on winners. So, or if it's such a great business that a loser could run it. But that's really the most important thing. Have they done what they said they were going to do in the past? And if so, I'll give them the benefit of the doubt until the numbers don't prove it out. So with that said, I want to thank everyone for tuning in. We'll be back next week, same time, same place. In the meantime, make it a great one. Bye for now.